If you are working and contribute to any form of a retirement plan, then this video is for you. There are changes coming and they are effective on January 1st of 2025. Today, we're tackling the new contribution limits. Let's look at the data. Whether you're maxing out your 401k, contributing to an IRA, or taking advantage of a health savings account, these changes can make a big difference. Retirement planning is about making the most of every single dollar that you save, and the latest updates from the IRS give us more room to do just that. So, what's changing and how can you take full advantage of these new limits? Well, the first is your 401k contribution limits. For 2025, the annual contribution limits are increasing to $23,000, which is up from $22,500 in 2024. If you're 50 or older, you can add an extra $7,500 in catch-up contributions, bringing your total potential contribution to $30,500. That's a $500 bump from last year, giving late savers even more opportunities to boost their retirement funds. The best part about the 401k contribution limits is that they are not restricted by your income. No matter how much money you make, you can contribute to a 401k plan. There are several key questions and considerations that you should be asking yourself before you contribute. Firstly, how much does my employer offer as a match, and am I taking full advantage of it? If your employer offers you a 6% match, you should at least contribute 6% to the 401k. If not, you're missing out on a 100% return. If you're making $100,000 a year and your employer would match 6%, then you're missing out on $6,000 of retirement savings that you will never get back. However, if you can contribute 6%, then you earn the other $6,000 that your employer is offering. Secondly, should you invest into the traditional 401k or the Roth 401k? This is a little bit trickier of a question, and to be honest with you, it's hard to set a hard and fast rule around this. The main idea or question is, do you think that you'll be paying more or less taxes in retirement? If you think that you'll pay more in retirement, then you should probably contribute to the Roth. If you think that you'll pay less in retirement, then you should probably contribute to the traditional 401k plan. The best rule that I have found, in my humble opinion, is around the idea from Money Guy Show. They state that if your marginal tax rate is above 30%, which includes your federal and state taxes, then you should contribute to the traditional 401k plan. If your marginal tax rate is beneath 30%, then you should probably consider the Roth. In the state of Arkansas, where I live, that would mean if you make less than around $400,000, you should probably contribute to the Roth 401k. And if you make more than that, then you might consider the traditional 401k. Thirdly, are you actually investing your contributions? Most plans do this automatically, but you should make sure that the money you are contributing into the 401k isn't just sitting in cash. It should be invested into something. The second change is around IRA contribution limits. Traditional and Roth IRA contribution limits are also rising, moving up from $6,500 to $7,000. The catch-up contributions for those over 50 is still $1,000, which means older investors can set aside $8,000 annually. This starts to get much trickier than the 401k on whether you can or cannot contribute to these plans. I'll put a chart on the screen for traditional IRA contribution limits and rules. There are several parts to this, so I'll also link NerdWallet's article on this below for you to review. Basically, there are two parts to if you can deduct an IRA contribution from your taxes. The first is if you work for an employer who offers a plan, and the second is if you are under the income limits to contribute to a plan. Take a look at the single or head of household filing on the screen. If you make less than $77,000, you can deduct your IRA contribution, but then it phases out until you make around $87,000. Then you cannot deduct these IRA contributions. Now on the screen, you can see the Roth IRA contribution limits. If you're single and you make less than $146,000, you can contribute to a Roth IRA. So the income limitations are much more lenient for the Roth IRA than the traditional. It should be noted the income restrictions only apply to Roth IRA contributions and not Roth IRA conversions. If you want, you can almost always convert your pre-tax money into a Roth, but beware, you will owe tax when you do this, so you should probably speak to your CPA or tax advisor about this. The third change is around simple IRAs and SEP IRAs. For small business owners and self-employed individuals, the contribution limit for simple IRAs is climbing to $17,000. That's up from $15,500. SEP IRAs will also see a rise in contribution limits tied to 25% of income at a maximum amount of $67,000 of your compensation limit. There are many more rules around these plans. I would recommend you talk to your financial advisor or your CPA about these plans. The fourth is health savings accounts. While not technically a retirement account, HSAs are another powerful tool in your retirement planning. In 2025, individual contribution limits are increasing to $4,150, while for the family, that's $8,300. If you're 55 or older, you can tack an extra $1,000 in catch-up contributions on top of that. This is huge. If you don't know about the awesome account that is the HSA, I would encourage you to look into it. There's no other place that gives you a triple tax advantage. Number 5. New matching rules from your employers that offer 401k plans may also have some flexibility around matching contributions with your Roth dollars starting in 2025. This means employees won't just save pre-tax, they can grow their after-tax savings faster, creating more tax-free income in retirement. I hope you enjoyed this video. This was meant to be a quick and easy guide for a few of the changes coming in 2025. Of course, this is not exhaustive, so if there's something that you'd like a deeper dive into, let me know in the comments below. And if you've been contributing to your retirement accounts and it's about time to take distributions, I did a video on some withdrawal strategies here.